Okay, so Warren Buffett just released this 2023 Berkshire Hathaway Annual Shareholder letter where I wanted to share with you guys 6 powerful investing lessons that all investors need to know about. Lesson number 1, be a business picker, not a stock picker. To be a stock market investor certainly has its benefits. It allows you to passively own a piece of some of the greatest companies on the planet. And the way that Berkshire Hathaway goes about buying those companies is by investing in those who have both long-lasting favorable economic characteristics and trustworthy managers. Now, when we talk about economic characteristics, I'm going to assume that Warren Buffett is actually talking about one of his commonly used investing terms, which is something called an economic moat. Now, an economic moat refers to a business's ability to maintain a competitive advantage over its competitors. Let's take Apple as an example, which is one of Warren Buffett's biggest holdings with a total value of $116.3 billion. Of course, Apple has its competitive advantages. And for me, there's 2 things that stand out. The first thing being the size of the company. Apple has a market value of $2.35 trillion, which has only been as a result of continuing to generate revenue and profits and providing value back to shareholders. And as a result, making it the biggest company in the United States as of right now. And of course, with that financial size comes its advantages. Cost advantages from having factories in China, marketing advantages from having 1.5 billion active iPhone users, and financing advantages from having $20.5 billion held in cash on their balance sheet. And the list really does go on. The second thing that stands out is high switching costs. Apple certainly has the benefit of network effects. Here I have my iPhone, I've got my iPad, and I've got my MacBook, which is all hooked up to the iCloud, which has everything saved from pictures right the way through to passwords. And in order for me to jump ship from Apple and move to, let's say, an Android product would be an absolute nightmare. And because of that, people stay where it's certainly most convenient. And with that comes long-term financial advantages for Apple as a business. So the crucial point to make here from the letter, and I quote, "Charlie and I are not stock pickers, we are business pickers. So look for the advantages that the business has, and you'll certainly do just fine when it comes to investing." Lesson number 2, less is sometimes more. The weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s as well. Buffett highlights that just a few decisions can actually generate you most of, if not all of, your investment returns. You just have to be patient enough to realize them. What I like about the letter is that Buffett actually gives 2 great examples of this in action, where just 2 of the investments that he made about 30 years ago have simply paid him dividends over time, and I mean that in a very literal sense too. One of those investments being Coca-Cola stock. In 1994, Buffett invested in 400 million shares for a total cost of $1.3 billion. That same year, Berkshire Hathaway received a dividend from that investment of $74 million. But get this right, fast forward 28 years, and that dividend today is actually valued at $704 million per year. That's an 838% growth rate just on the dividends alone. And that's before you even go on to consider that the fact that the value of the shares are actually valued at about $25 billion, which is a gain of 1,823% since 1994. The other great investment that Warren Buffett talks about is his investment in American Express back in 1995, where he also invested $1.3 billion. Since then, his annual dividends from that investment have grown from $41 million per year to $302 million per year, which is a gain of 636%. Not too bad for a little bit of passive income. And as at the end of 2022, Berkshire's investment in Amex was actually valued at $22 billion. An upside of 1,592%. Now, I certainly appreciate the fact that Warren Buffett started his investments, especially within these companies, with billions of dollars already, and perhaps that might be a little bit hard to resonate with. But if we say applied a more normal investment amount for us normal people of £13,000 in Coca-Cola stock right the way back in 1994, which was just the equivalent of 0.001% of Buffett's total investment, then today your dividends would be worth £7,040 per year, and your investment would actually be valued at over £250,000. If you do that just twice, just like Warren Buffett did, then you'd be sat on a completely passive salary for the rest of your life, along with an investment portfolio value of over £500,000, and that's more than some people are able to retire on. Lesson number 3, the power of compounding. One of my favorite quotes from the annual shareholder letter is that there is no finish line. And with that in mind, I think it's important because it makes us think more about the investing journey rather than the destination. And it also emphasizes the point that investing is a long-term game, and it's certainly not a short-term get-rich-quick scheme. As Buffett showed with his examples of Coca-Cola and American Express, the longer that you can invest for, the more money that you'll make. And that's thanks to the power of compounding, to the point where you're compounding more wealth through your investments than you're actually contributing to the portfolio itself. Warren Buffett gets 50% of his total principal investment in Coca-Cola back every single year just through dividends. I guess it can be somewhat difficult to comprehend just how you can turn a relatively small sum of money into such a huge sum of money which has so much upside in the form of passive income too, or at least in the context of Warren Buffett's wealth anyway. And the reason for that is because the way our minds work is more in a linear fashion. We think more about gradual and progressive gains over time, which is obviously understandable. But with the power of compounding, the gains aren't linear. Instead, they're exponential. It's like rolling a snowball downhill. The further it goes, the bigger it gets. And the exact same works for your money too. To give you an example, an investment of just £500 a month, compounded for 40 years with a 2% inflationary adjustment on top of your deposits every single year, when you're achieving a rate of return of say 8% per year, you'll actually be left with £2,192,380 within your investment portfolio. That's the power of compounding in action, but I just guess applied to us more normal people that don't have billions of dollars sat around in a bank account ready to invest. And regardless, it still ends up to be quite a decent sum of money. Lesson number 4, control what you can and ignore the rest. All of these clips are just from today. Tons of market commentary from all different analysts about their future predictions about the stock market and its performance. But here's some wisdom from the letter. It says, Charlie and I plead ignorance and firmly believe that near-term economic and market forecasts are worse than useless. And it's true, right? Because it's impossible to predict the markets, especially in the short term. Or as Matthew McConaughey says in The Wolf of Wall Street,
okay, if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in circles, least of all stockbrokers.
So with that in mind, the most reliable way to achieve success in the stock market, statistically speaking, is to simply invest for the long term. And when I say long term, I'm talking about a time horizon of 10 years or more. Forget about what's happened in the past 12 months or so whilst the stock market has been selling off, because it's absolutely irrelevant, especially in the grand scheme of things. Because actually, the longer that you invest, the higher probability of success that you have. Actually, looking back at some of the historical data, investing in the stock market for 12 years or more pretty much guarantees you to make money. So don't focus too much on the short-term fluctuations within the stock market. Instead, take the set it and forget it approach, continuously make your investments, and then perhaps come back in 10 years and see how you've done. Lesson number 5, bet on America. Buffett says, I've been investing for 80 years, more than 1/3 of our country's lifetime. Despite our citizens' enthusiasm for self-criticism and self-doubt, I have yet to see a time when it made sense to make a long-term bet against America. And I very much doubt that any reader of this letter will have a different experience in the future. And look, I certainly have to agree with Warren Buffett on this point. It's why I've got near on £40,000 of my own money invested into the US market. Short-term performance might not stand to be all too great with kind of high and sticky inflation along with rising interest rates too. But I guess that's just kind of the same for all equity markets out there. And truth be told, we're probably not set up for the best returns over the next decade or so, thanks to the current macroeconomic environment. We've gone from a period of time of cheap money with historically low interest rates to now a very quick transition to where money is becoming now more expensive. And as Warren Buffett says, interest rates are like gravity on stock prices. So with that in mind, when you start to look at some of the future market forecasts for the next 10 years, there was one report written up by Charles Schwab that concluded that US large cap stocks would provide annualized returns of 6.4% over the next 10 years from 2022 to 2031. Certainly not as high as the historical longer-term averages of 10.5%, but gains are still gains. As an investor, you simply have to take the rough with the smooth and just simply understand that some decades are going to be better than others. And if what's classified as a rough decade still accounts for annualized returns of 6.4% per year, providing that figure is above the inflation rate on a 10-year basis, then our real wealth should still be increasing during that period of time, which of course is the most important thing to focus on. Lesson number 6, value is greater than votes. In Charlie's list of rules, he wrote a quote from Benjamin Graham, who said that day to day the stock market is a voting machine, and in the long term it's a weighing machine. Now what this means for investors, or especially the newer investor perhaps, is that it's very easy to jump on the next hot stock or follow the latest trend or whatever's most popular at the time. We saw that with the likes of GameStop, and we all know how that ended. But fundamentally, Buffett says if you continue to make something more valuable, then some wise person is going to notice it and start buying. So focus on companies that have value, something of worth and substance. It is admittedly harder to find stocks that are trading at fair value, if you like, thanks to historically high inflationary adjusted price to earnings levels of about 29 times earnings. But what's important to recognize is that those valuations are coming down, and the more that they come down, the better the opportunity for us as investors to pick up some bargains within the stock market. Because as Warren Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But one critical piece of advice that Warren Buffett didn't include in his annual shareholder letter was that the average investor, statistically speaking, should simply just invest in a low-cost index fund. So if you do want to know what I think are the top 6 index funds over on Vanguard, then be sure to click on that video next. Be sure to subscribe on the way out. And with that being said, I'll see you over in the next one.